I'm Brendan Yurik. I'm the CEO and Director of Electric Royalties. We are a royalty company focused exclusively on those clean energy metals required for the world to move forward to a clean energy future. We've got 21 royalties in our portfolio to date. We just closed our second producing royalty acquisition. We've got another couple that we expect to come into production over the next year. And so it's exciting times. We're really looking forward to 2023.
Brendan, thank you for the introduction. Good to speak to you again. You've just bought your second producing royalty. Just for the sake of the viewers, can you just remind me about the first producing royalty, and then we'll come on to the second one. So the first producing royalty is?
Yeah, so our first producing royalty is on a zinc mine in the U.S. Operated intermittently for over 50 years. Produced over 2 billion pounds of zinc. The operator is Trafigura, so they're a very, very well-established group. They've got lots of capital, and they took that over from Nearstar. I think it was about 2019. But fantastic mine. It's actually vertically integrated with the Crux smelter, which is the only primary zinc producer in the U.S. And so that's paying. We acquired that with Sprott coming in alongside of us. And so they put in about 13.5 million cash alongside of us to get that deal done a couple years ago. But a very steady paying royalty, something that we expect to pay for a long time to come. And we really like zinc as well, and that outlook for price. And then the second producing royalty. Yeah.
Sorry, before we get onto that, what does that first royalty contribute to you in terms of cash flow on an annual basis? And I know it varies, but but roughly, what are you expecting this year to come from that?
Yeah, about $500,000 Canadian, and we actually do have an option that will come in August of this year, whereby we could actually double our royalty interest in that, so that would push it up to about $1 million a year. And so that's coming due in August of this year, but right now it's about 500,000.
Are you thinking, what's the current thinking on terms of your allocation of capital? Do you think that's a probability that you're going to go for it?
Yeah, I think I always like to wait, with options. It's the nice thing is you have some time, and so kind of see how things work out. Ultimately, a lot of that will have to do with, what our valuation is at. Does it make sense from a relative standpoint? But, I would like to. If we were properly valued, I'd definitely do it. That being said, I think that we're able to deploy capital potentially a little bit more efficiently and do some new deals, just like we recently did on Penouta.
There we go. It's a neat segue to the second asset, Penouta.
Yeah, well, it's the largest tin producer in Europe. Fantastic operating team. That was one of the big things that was important for me. If you're going to go into a small mining situation where they need capital, which is a perfect place for a royalty company to come in and provide some non-dilutive capital. You really want to make sure you have a good operations team. And so these guys are a group that I was very comfortable with. They put several small mines in production in Colombia. And I love tin. It's probably one of my favorite metals to be able to get the only tin producer in Europe and get a metal on that mine. They have a license to mine there. I think it's 75 years, renewable, 30 years renewable for up to 75 years.
Where is it?
Yeah, it's in Spain. So they've been mining there since ancient Roman times, really. And so it's one of those ore bodies. Everything they dig up is ore. It's pretty special.
Is it in that tin tungsten belt on the west towards Portugal in Extremadura?
I don't have the chart, the map out to tell you exactly where it was lying there. But yeah, it's definitely within that Spanish belt. Would be what I say.
Okay, good. Well, have you been out there yet? I mean, have you actually visited site yet?
Unfortunately, I haven't been out there yet. But we did send somebody, so we had an independent engineer go check it out. And when we did that deal, we had to close that over the holidays, so it was a little bit tighter in terms of trying to get people there, get things done. So I haven't had an opportunity yet to go out there, but we actually have an option on that royalty as well. Like a lot of our deals that we do, where we could actually double our royalty interest in that as well. And we have 7 months from closing, and we just recently closed that. So at some point over the next 5, 6, 7 months, I'd expect that I'd make it out there. Ahead of us deciding to pull the trigger.
Well, if you ever want a guide to help you, I'd be most delighted to come with you, because that part of Spain, the food and the wine is totally delicious and the people are great. But that's quite a different thing. Tell me about what was the size of the transaction? How much did you invest, and what percentage royalty did you get?
Yeah, so we actually were able to get that deal done with very minimal cash, which I think speaks to the lack of capital really in this space still. It only cost us $1 million cash, and then some shares of Electric Royalties, a nominal amount. But yeah, for $1 million, and that's a situation where these guys are going through ramp up and, they need $1 million. And if you try and go to the equity markets and raise equity at that time, the bankers are going to kill you. It'll be 5 cents and it'll be, full warrant and that. So, having somebody like us that can step in and, you always need a little bit more capital when you're just bootstrapping things at that time. And so it's just a win-win for both parties. Where we get in and get in at a price that we can afford and get that long-term upside and exposure to an asset we think will be producing for a long time to come.
And what was the royalty in a percentage-wise?
So we had a 0.75% gross revenue royalty for that. Once we've recouped basically our after-tax cost of that, which would be about $1.6 million, then it drops down to 0.5%. So you lose 0.25%, and then the option is the exact same. The options doesn't have any shares of Electric Royalty in the acquisition cost, but it would be 1.25 million Canadian cash. That would get us basically the exact same royalty, a 0.75% royalty that basically reduced down to 0.5% after we'd recouped Canadian $1.67 million from that royalty.
And
yeah,
what is their production output expected to be, for example, this year?
Yeah, well, it's a little more complicated than that. Like, it's actually an industrial mine site. There's a lot of different metals and stuff that they can agglomerate and make revenue off of, and that's really going to be part of the push this year. Part of the capital that we gave them is going to allow them to, start exporting high-grade feldspar that they already have on site. They have tin is definitely the majority of their revenues to date. It's a little over 50%. They also have tantalum revenues, and that would be another big one. That'd be, again, I think about 40% of it. So in terms of aggregate production, it's, I don't have a gold equivalent ounce calculation for you. But like I said, these guys are the most significant tin producer, tantalum producer in all of Europe. And so there wasn't really any, other options or any bigger producers out there for us to, go work with and try and finance. I think that's part of the exciting thing is that we're working with this team now. I think there's going to be a consolidation, especially in the tin space is right for it. And we'd like to be the group that's there to help that consolidation and help these groups grow.
Do you have do you take a royalty just on the tin and the tantalum, or what's the split between the
revenue,
two?
Yeah, we keep a gross revenue, so it'd be on everything.
Oh, on everything from that mine site. So yeah, from Penouta, whatever comes out the door, you've got the gross revenue.
Yeah, it's safer that way. Leaves less room for people to kind of optimize certain commodities or put. Focus on. Not that our royalty necessarily would lead them to do that. We try and keep our royalties to a pretty modest level that aren't going to hurt the operation. The longer they're producing, the more money we make. So, but yeah, it would be on across all of their revenue streams. They have some potential for niobium as well, down the road. But we're excited. I think helping shine a light on those guys and what they're doing there, I think they're going to see a lot more interest, hopefully out of Europe as well, because as crazy as it sounds, Europe is far behind on all these critical metals, but they're doing very little to actually support the few groups that are producing or have a chance to produce in the near future.
In dollar terms, what are you expecting to come from Penouta in your royalty for this year?
Yeah, so if I look at their kind of historical revenues and let's ballpark and say on an annual basis, as of today, they're making around US $20 million. We expected that it was going to be, in that range of around $200,000 Canadian, US 20 to 25 million. And we thought, in the 150 to 200K range on a fairly conservative basis. Tin prices are half of where they were, a year ago. We think there's upside in the tantalum as well, but also on their production profile. These guys have been steadily improving operations, continually increasing production. That's what, bootstrapping. They came in with very little capital, right? So it takes a little bit more time to ramp up production. But they're doing it, and there's some further upside from there. 12, 15 months out, I think they're going to come to a decision. Do we expand the plant capacity? Because they have a lot of the pieces there, and really for $10 to $15 million, they could double production. And so I think that'll be, another kind of a nice upside that we'll see come to fruition over the next kind of 24 months.
Really what you're building a picture of is a company in Electric Royalties that has got these two elements of income. You're looking at $650,000 to $700,000 of income, and presumably your overheads are relatively low, and then you've got the optionality on the other side. So, tell me what your overheads are, please, and what your cash balance is at the moment.
Yeah, so our G&A is very low. I think kind of all in last year, we're about $1.5 million. And of that, we were heavy on marketing last year. So we spent over $500,000 on marketing, trying a lot of different things out, mainly because we felt we were so undervalued. But that's definitely something that, I think we figured out what works, what doesn't, and we could definitely be shaving down. And then really deal costs, honestly, would be about a third of that as well. And so I wouldn't really call that traditional G&A. If we're not doing deals, then that cost is gone. But every time we do a deal, especially because we're one of the few royalty groups out there that creates new royalties, that's a little more expensive from a legal side. It costs maybe $50,000, $150K per deal. If you're creating a brand new royalty out of nothing, because you got to negotiate all the agreements from nothing, right? So it takes a little bit longer. The lawyers get their teeth into it a bit, but so that's about a third of it as well. And then from there, it's like our listing costs. We keep everything pretty lean. We use back office services, so as needed, and on the technical side as well. So if we're not doing deals, our G&A could theoretically be very, very, very low.
So you've effectively got your kind of true G&A covered, with a little bit of headroom for a little bit of marketing and the occasional deal. That's just on the income. What about your? You raised $4.5 million last year. Is that right? Is any of that left?
3.4 million. Yeah,
3.4.
Yeah, 3.4 million equity. That was about March. So kind of just as Putin kicked things off in Ukraine, and markets were pretty tough. We wanted to get some capital. We had our Sayona copper deal to get done. So we used a lot of the cash actually to close that deal. And then we did put in place right now just a fairly limited facility. It's a convertible facility with one of our largest shareholders. They own over 17% of the company, and it's very favorable. There's no early payback terms. There's no interest. Everything is capitalized until the end. It's a 3-year term. There's a convertible piece where it can actually convert into equity at 50 cents a share. So there's a lot of, there's no setup fee. There was no structuring fee, nothing like that. So about as favorable a facility as you could find.
So how much was it?
So we only have agreed on $2 million as of now, and that was primarily because of me. We're working on some other financing options, and there's a lot of money right now at this space that is definitely keen to get involved and grow their exposure in this space. So we're just kind of maybe just kind of seeing what comes. But there is potential there, quite frankly. Stefan is a fantastic shareholder. He said that he would up that facility to $10 million if we wanted. And so, I think it at least puts pressure on other groups for terms, if they're talking about coming to the table with us.
Yeah, good. It's always good to have a bit of competitive tension in any bid situation. I noticed you've got you've picked up the Rana nickel asset, but before we talk about that, let's talk about Sayona Lithium, because the Authier project's about to come into production, which is another one of your royalties that you've got in your portfolio.
Yeah, there's an exciting one too. It's one of the first royalties we picked up. We picked it up about 2.5 years ago, and when we acquired it, the operator Sayona Mining, I think they had about a $6 million market cap. Lithium spot demand prices were about $400 a ton. Fast forward to today, they're over $5,000 a ton. Sayona is over a $2 billion market cap last time I checked. And so, they're fully funded to go to production. They've been, I think, procurement and production was about 90% there as of about a month ago. They have all the permits in place. And essentially, the Canada Lithium mine is ramping up production, and they are planning to blend ore from the Authier project, which sits right next door, to help that ramp up. And they're planning to produce about 108,000 tons of lithium concentrate a year at the Canada Lithium mine, of which about 33% of that ore is going to come from Authier. So about 60,000 tons or so a year you expect to come from the project that we have a royalty on. But it's going to be the largest producing lithium mine in Canada next year. These lithium prices, it's going to make a lot more money than we expected when we acquired it. And we're excited. Yeah, that'll be our third producing royalty. And that could happen anytime over the next couple months. Their target date was Q1. And, we don't see anything to say that that's not going to happen. But that's exciting. And like you said, I mean, there's the revenue income side. This will be our third of 21 royalties producing. But we have 18 others that are all being developed along that path. We had 9 updates just this last month alone. And so there's a lot of activity as these royalties are going to keep moving left.
Let's just stick with the OTA. What at current prices, what are you expecting in terms of cash flow over the course of, let's call it a year from Q2 to Q2 next, Q2 23 to Q2 24, if they hit nameplate capacity and metal prices are what they are today?
Yeah, well, now you might get me in trouble here. It's difficult for me to be able to give investors forecasts when there's an Australian company that owns one of our assets, as is the case here, because they don't have an NI43-101 that's up there for investors to go see and review. I have to be careful in terms of what I can forecast.
Is there a JORC report? Because Australian companies need to publish JORC results. I do know that the Canadian Stock Exchange insists that companies publish the full NI 43-101, whereas in Australia, the companies are only obliged to publish the summary, so they don't necessarily provide the full background detail. Is that the case? Is that the situation here?
Yeah, that's exactly the situation here. And I don't think I've ever seen an Australian company actually publish their JORC online, but yeah, that is the case. And as a Canadian listed company, it just makes it more difficult for us forecasting. But we expect that royalty is going to be a major paying royalty. I wish I could say more.
Well, let me ask you this: what is the royalty that you are publicly able to talk about on OTA?
Yeah, well, so I mean, we have a 0.5% gross revenue royalty on OTA. We do have 2% gross revenue royalties in and around on the exploration claims. I will say this makes it a little bit more difficult in terms of forecasting as well, but it's the only royalty in our entire portfolio that doesn't cover the entire deposit. So it covers about half the deposit. So when you look at Sayona putting in the Canada Lithium mine back in production, their target nameplate is about 180,000 tons a year, of which about 33% is expected to be ore from OJ. So that'd be about 60,000 tons a year. You cut that in half, our exposure would be about 30,000 tons a year. So you can, I'll let you run the numbers and say it.
Great.
And 0.5% times, 5,000, 5,500, whatever you want to use.
Okay. I will do the maths. Thank you. Good. Now I won't repeat it out loud in public, but I will simulate that internally. Good. That is expected to come into production Q1, and obviously there'll be a ramp up period. And the resources sector is famous for being late and over budget, so all of those will have to be factored into the expectations. One needs to dial one's expectations down to cope with the poor performance of the resources sector. Yet, despite that, we are in a period of increasing demand for battery metals, lithium prices, nickel prices. Can you just give me your opinion on where we are in the macro and where this kind of moving train has got to in industrial thinking?
Yeah, well, I just think everybody's still kind of missing the point. We were already running out of a lot of these resources before the clean energy transition. We knew 10 years ago we were going to need a new copper mine like Escondida every couple of years just to fill the copper supply gap that we see coming over the next kind of 5-10 years. You add in the electrification of the entire planet and moving towards clean energy and all the different extra demand hits that are going across, zinc, copper, nickel, tin, all the metals that we chase. And it's just crazy. I mean, the supply side hasn't gotten better. It's not getting any better. We've mined out a lot of the best deposits on Earth already, and we're not finding any more. Even copper exploration is up to an all-time high. The number of discoveries is still, not happening, as has been the case for about, the last 10 years. I mean, think about how many major discoveries we've had. And so I just see a major supply issue for a lot of these metals. And you're talking about 8 billion people on this planet. You're talking about compounded growth on demand. So every year, it's about an extra 7% on top of the 7% every year that has grown before. And so you're talking astronomical numbers, for these metals that we need. You're talking about 5, 6, 7 times increases in production. And to your point, when we try and go in and start producing these metals, there's always issues, especially when you're at the forefront of a lot of these groups trying to, create something new. Whether it's the manganese developers or, the nickel developers. But there's a lot of new challenges that groups are facing, as well as trying to make them, have a cleaner carbon footprint as well. So a lot of new technologies being involved. But just really, honestly, on the supply side, I don't see how we don't see very high metal prices moving forward. I would call it a super cycle, and I'd say, the next 10, 20 years, look pretty good for metals that we actually need, not gold per se, but metals that we actually need.
Well, there are other people who can articulate a pretty cogent rationale for the gold price remaining strong, but let's not use this forum for that particular argument. Working on that supply-demand rationale, that you've got this this super cycle coming through, supply constraints due to a whole variety of reasons, geological scarcity, lack of exploration, new technology, you name it. How do you value a royalty company? What's a forward cash flow multiple that you'd be comfortable saying that these companies should be on? 10 times cash flow, or 20 times, or 30 times? What's the basis?
Yeah, it's always kind of funny for me when we talk about valuation multiples, because if you look at us, on our valuation multiples, we're trading at, a fraction of where we should. But I just look at what junior royalty groups out there typically trade at. The average, last I checked, was about 10 times cash flow. And the net at PNAV was about 1 times NAV. So, we'd love to be at 1 times NAV. I think like I said, we're at a very fraction of that. But that's typically what you see. The nice thing is, as a royalty group gets bigger, that 10 times cash flow goes up to 25, 30. The PNAV goes up from 1 to 2. And so, as we keep growing, and if we can get to that kind of, level, a lot of that just kind of, kicks in as well. It's just other benefit of the royalty business model. As you get more diversified, you start to get a little bit better multiple as well.
Excellent. So what how do you see you trading at the moment in your PNAV? Where do you think you call yourself at?
Well, I'd say less than 20% of that. It's tough for me to be able to kind of calculate. I don't know if we have an internal PNAV, but if you look across our portfolio, 21 royalties, let's just take the Middle Tennessee Zinc royalty. That's paying out, $500,000 a year right now. If you took a 10x valuation on that, that'd be about $5 million. You look at Penouta, let's just say it was $200,000 a year. 10x would be another $2 million. We have 19 more royalties. One of them, the Battery Hill royalty, or Manganese royalty, the only real district in North America that's going to be the next source of manganese for the battery space. We're expecting that one to be anywhere from US $3.5 to $5 million a year. They have 40 plus year mine life on that. So, just that royalty once in production, you can see would be maybe equal to our entire market cap today. So I think there's a lot of growth value, in a PNAV, we'd be able to see that. I can't really share, that detailed one necessarily with you guys, but you'd be able to see that kind of boost in value outside of the cash flow. And that's really where a lot of our value is today. I think is our development projects that we have out there. And even over the next couple of years, but really 3 years out, 4 years out, we have some big projects we expect to come into production that really could change the needle. But we do actually have a couple of graphite projects that over the next kind of 12 to 24 months, we think, could be very interesting. Crop could come into production. It was already in production for 20 months continuously. They shut down because of COVID restrictions in the country. So they could bring that back into production very, very quickly this year. And then Northern Graphite, they just signed a joint venture agreement to open a very big facility in Eastern Canada. And they also indicated as part of that, they were looking at potentially doing a 100,000 ton per year case at Bissett Creek. Now, Bissett Creek, initially, I think about 25,000 tons a year was the planned production profile. So that would be a 4x, increase in terms of the cash flow. It's basically feasibility stage ready to go. And so as soon as they finish assimilating those producing mines that they've already acquired, we'd expect that would be their next asset to put in production. And, Northern Graphite's now one of the largest graphite producers outside of China. So great operator to do it.
When you talk about Battery Hill, they're only at the PFS stage. It might be a good project, but a large complex project like this does take an awfully long time to come into production. I mean, particularly with a kind of a logistics exercise that any bulk mineral development is. The timelines for development are longer than for let's come back to our old favorite gold, for example. It can be 5, 10, 15 years before something comes into production. So
I think lithium might be the quickest out of the game now. I mean, I thought we're looking at 7, 8 years was kind of their target timeline, and I've seen these things move pretty quickly. You'd be right in some cases, yeah. I mean, I think the manganese one is kind of interesting because even though it's typically a bulker commodity, when they're doing the upgrading of the process and you're selling it at $2,900 a ton, I think it's a little bit of a different game than it would be if it was, say, an iron ore project, which is more traditional bulk, because they're mining a lot more ore, but they're really upgrading it, at site. And for these guys, the reason why I like them, the most of really any of these manganese developers globally is that the metallurgy is most advanced. They've been working at it for 3 years with Cameco. Cameco is a great group. And so they've got the metallurgy nailed down. And you look at some of the other groups out there, they've done bench scale tests, and that's really where you'll get in trouble. From an ore body perspective, they don't have to poke very many drill holes down to find the ore body. It's pretty safe in that regard. But it's all about the metallurgy on that, and those guys are, very advanced. I'd expect there's going to be a group that's going to come take over, and dominate that space, like the mineral sands industry. This would be one of the projects, just like Rio Tinto has one in Eastern Canada for mineral sands. I'd expect something for this as well.
Let's say you're trading at a fifth of your or less of your appropriate PNAV. Your market capitalization today is 25 million US or 33 Canadian. How are you going to close that? How are you going to close that discount gap? What are the catalysts, the value catalysts you've got to deliver in terms of news to be able to kind of close that? Because even if you close it to 50%, to half PNAV, that's a double in your share price.
Yeah, and which means a lot because, myself, I'm fully invested in the company. I'm about 95% invested. My family is big shareholders. And so I really care about that. And we obviously, we'd love to get to a proper valuation. I think a lot of the catalysts, in the near term, are going to come partially from OCHE coming in production, having our capital start to come in from Penouta. We have options on both Penouta and our Middle Tennessee Zinc royalty to increase them this year. And so that'll make us, cash flow positive is our expectation amongst those. And I think that's a big catalyst for a company. And so, part of that'll be, hopefully come from that aspect. We have some bigger transactions and some other deals in the works that we're, hoping that'll also give us a boost. We've got a fantastic pipeline of deals, about 50 different deals in our pipeline. And we're just, actively pushing on those, seeing, which ones would be a good fit and hammering out terms. But we've got a lot of new deals that we could do. Ultimately, I think there's a lot of private equity money out there that I think is going to start snipping around as well. And, if we can't get there or we can't get to real estate valuation, I think the private equity guys would be more than happy to buy us at anywhere near, where we're trading. So, we'll see how this year goes. But there's a couple of big private equity portfolios out there right now that I know are making the rounds. And the valuation relative, to us, which would be, the only kind of semblance of a clean energy metal royalty portfolio, I think they make us look, starkly undervalued. So it should be a interesting year, and hopefully we start to get re-rated a bit.
Well, that's the critical thing, isn't it? It's your value relative to peers in the sense that if you can demonstrate that you're trading at 0.2 or less of your price to NAV, or your cash flow multiples are a fraction of what your peers are, and you have a couple of entries into the market at much higher valuations, and then on a relative valuation basis, you can appreciate.
Yeah, well, I think a part of it, we might be a victim of our own success a little bit because our acquisition costs are so low on some of these deals. When you look at even, say, Seymour Lake, we acquired that about a year and a half ago. We only paid $1 million in shares. You fast forward to today, where lithium prices have gone, one part of it, but they've partnered with Lithium Americas. They've raised $70 million in the last kind of 7-8 months. They're planning to fast track that to production. And so the value of these royalties is steadily growing and increasing, and we see that, but it's tougher, I think, for investors to see, when we pay so little, how could it be worth so much, even a year or two later. But the reality is that the value has been growing, and at some point here, as these get closer to production, we hope to get more value for them. But this year, like I said, we're hoping to get our third royalty into production, potentially even a fourth. And that's outside of us doing any new deals. But cash flow positive is kind of the first hope that we have, I guess, to help get re-rated.
Good. Well, I look forward to the re-rating. I look forward to speaking to you again when either Authier comes into production, which will hopefully be soon, or you do a new deal, or the fourth producing royalty comes into sight. But Brendan, thank you very much for the update. It's been a fascinating take on the wild ride of battery metals commodities. Royalties.
Thanks, Merlin. I appreciate it. It's not too wild of a ride as a battery metal royalty company. I think it's now that we have a portfolio of 21 royalties. There's been close to 500 million raised over the last kind of 2 years now in our portfolio. We just had another 15 million go into our nickel asset, Rana in Norway. And so it's easy for us because, there's management teams out there working on our assets every day. And we have no extra costs. We just kind of sit back and let these develop and go acquire new assets. So life is good as a royalty company, and definitely in the battery metal space.